The 10 biggest financial risks to watch out for. In this guide, we'll explore the key risks that can impact your financial well-being. From market volatility and economic downturns to inflation and geopolitical instability, we'll examine the factors that can threaten your financial security. By understanding these risks and implementing appropriate risk management strategies, you can safeguard your investments and mitigate potential losses. Join us as we identify the top financial risks and learn how to navigate them effectively to protect your wealth. Today, we will talk about the 10 biggest financial risks to watch out for. So before we get started, make sure to hit that like button, also subscribe to my channel. In the ever-changing landscape of personal and business finance, understanding and managing financial risks is crucial for achieving long-term financial stability and success. From economic downturns to unexpected expenses, there are various risks that can impact individuals and organizations alike. In this comprehensive guide, we will explore the top 10 biggest financial risks to watch out for. 1. Economic downturns. Economic downturns, such as recessions or depressions, pose significant financial risks to individuals, businesses, and the overall economy. During periods of economic contraction, consumer spending declines, unemployment rates rise, and asset values may plummet. This can lead to decreased revenues for businesses, job losses, and financial hardships for individuals. To mitigate the impact of economic downturns, individuals and businesses should maintain emergency funds, diversify their income sources, and adopt conservative financial strategies, such as reducing debt and cutting discretionary expenses. 2. Market volatility. Market volatility refers to the fluctuation in asset prices, such as stocks, bonds, and commodities, due to changes in investor sentiment, economic indicators, or geopolitical events. High levels of market volatility can lead to increased uncertainty and risk for investors, as asset prices may experience sharp swings in value over short periods. To manage the risk of market volatility, investors should maintain a diversified portfolio, avoid timing the market, and focus on long-term investment goals rather than short-term fluctuations. 3. Interest rate fluctuations. Changes in interest rates can have a significant impact on borrowing costs, investment returns, and overall economic activity. Rising interest rates can increase borrowing costs for individuals and businesses, leading to higher mortgage rates, loan payments, and credit card interest charges. Conversely, falling interest rates can stimulate borrowing and spending, but may reduce returns on fixed-income investments, such as bonds and certificates of deposit. To manage interest rate risk, individuals and businesses should consider locking in fixed-rate loans, diversifying investments across asset classes, and staying informed about changes in monetary policy. 4. Inflation. Inflation, or the rate at which the general level of prices for goods and services rises over time, erodes purchasing power and reduces the real value of money. High levels of inflation can lead to decreased consumer purchasing power, reduced savings, and increased costs for businesses. To hedge against inflation risk, individuals and businesses should invest in inflation-protected securities, such as Treasury inflation-protected securities, real estate, and commodities. Additionally, maintaining a diversified investment portfolio can help mitigate the impact of inflation on overall returns. 5. Credit risk. Credit risk refers to the risk of default on debt obligations by borrowers, such as individuals, businesses, or governments. Lending money to borrowers with poor creditworthiness or investing in securities with low credit ratings can expose investors to credit risk. To manage credit risk, investors should conduct thorough due diligence on borrowers or issuers, diversify credit exposures across different borrowers or securities, and monitor credit ratings and financial health indicators regularly. 6. Liquidity risk. Liquidity risk refers to the risk of not being able to buy or sell assets quickly and at a fair price without causing a significant impact on their market value. Illiquid investments, such as real estate or private equity, may be difficult to sell quickly, especially during periods of market stress or economic downturns. To manage liquidity risk, investors should maintain a portion of their portfolio in liquid assets, such as cash, money market funds, or highly liquid securities. to meet short-term financial needs and take advantage of investment opportunities. 7. Currency risk. Currency risk, also known as exchange rate risk, arises from fluctuations in the value of foreign currencies relative to the investor's home currency. Investing in assets denominated in foreign currencies or conducting international business transactions can expose investors to currency risk. To hedge against currency risk, investors can use currency hedging techniques such as forward contracts or currency options to lock in exchange rates and protect against adverse currency movements. Additionally, diversifying currency exposures across different currencies can help mitigate the impact of currency risk on investment portfolios. 8. Regulatory and compliance risk. Regulatory and compliance risk arises from changes in laws, regulations, or government policies that may impact the operations, financial performance, or competitiveness of businesses. Non-compliance with regulatory requirements can result in legal liabilities, fines, reputational damage, and loss of business opportunities. To manage regulatory and compliance risk, businesses should stay informed about changes in regulations and industry standards, implement robust compliance programs and internal controls, and conduct regular audits to ensure adherence to legal and regulatory requirements. 9. Cybersecurity and data privacy risk. Cybersecurity and data privacy risk refers to the threat of unauthorized access, theft, or misuse of sensitive information and digital assets by hackers, cybercriminals, or malicious insiders. Data breaches can lead to financial losses, reputational damage, legal liabilities, and regulatory fines for businesses and individuals. To mitigate cybersecurity and data privacy risk, organizations should implement robust cybersecurity measures, such as encryption, firewalls, multi-factor authentication, and employee training programs. 10. Political and geopolitical risk. Political and geopolitical risk arises from changes in government policies, geopolitical tensions, conflicts, or instability in domestic or foreign regions that may impact economic conditions, trade relations, and business operations. Political events, such as elections, trade disputes, or geopolitical conflicts, can lead to increased uncertainty and volatility in financial markets. Navigating the complex landscape of financial risks requires a proactive approach and a comprehensive understanding of the potential risks and their implications. By identifying and assessing the top 10 biggest financial risks outlined in this guide, individuals and businesses can take appropriate measures to mitigate their impact and safeguard their financial well-being. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.